Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In the previous lesson, we introduced the most popular statements among professional investors, the balance sheet, the easy equation of assets equals liabilities plus equity, have many untold secrets. Vincent, head of Tiger Brokers community, believes that the balance sheet are rife with financial fraud. Among them, accounts receivable, inventories, fixed assets, and goodwill are particularly prone to fraud. In this lesson, we're gonna look at 4 common types of balance sheet fraud, which can help you avoid falling into the trap of financial fraud in your investment. 1. Financial fraud associated with accounts receivable. Accounts receivable refers to the money a company should have received for goods or service, but not yet paid for by its customers. As customers, we're familiar with cash on delivery and deferred payment. Deferred payment is accounts receivable for the seller, for example, the company. Why fraud happens in the accounts receivable? I'll give you an example. Jack's company purchased a quantity of raw materials from Rose's company. It is stipulated in the contract that $30,000 will be wired to the bank account of Rose's company 3 months after the goods are delivered. In other words, Jack received those goods now and pays money 3 months later. Thus, upon sale of the goods, Rose's company will book accounts receivable for $30,000, although it has not received money on the spot. Rose tells Jack and said our company has a large backlog of inventory recently. In order to clear some inventory materials, the company can sell you materials at a low price, but your company must purchase more than 5 times the regular purchase amount of materials at one time. Jack said that our company doesn't have enough money in such a short time. Rose then added, I can give you an extra deferral for 1 year. They signed the contracts and thought it was a bargain for their own companies. They returned to their respective companies and immediately commenced their questionable practice. On the basis of this contract, Rose booked in her company's financial report a huge increase in accounts receivable. As a result, revenue as well as share price soared. However, it soon backfired. Rose met strong resistance when she wanted to collect amounts receivable from Jack. Jack refused to pay the money on the ground that company is losing money. Thus, this amount of accounts receivable became bad debts. Due to the lack of capital, Rose's operation had problems and share prices also dropped. I believe you have acquired the logic and hazard of accounts receivable fraud. To avoid common pitfalls, we must pay extra attention to the following 2 situations. First, accounts receivable increases much faster than revenue, and the speed of collection is slower than industry average or appears to be slowing down. Second, accounts receivable takes up a great proportion of companies' revenue, and 30% of which is over 1 year. You should question about a company's revenue when you detect the 2 situations. 2. Financial fraud associated with inventory. Most products, such as fruits or pastry, have a quality guarantee period, beyond which the value of the products will significantly decrease. Some companies deliberately don't make allowance for depreciation of inventory in order to decrease expenses, increase profit, and thereby dress up the financial report. Moreover, many companies illegally forge orders to make funds flow out. Then they will use these funds to buy their own products in the name of other companies in order to fraudulently increase profit. This kind of fraud often causes inventory growth to exceed the same period of time. But you can make money by spending money on your own products, and you may have increased savings costs due to the inventory backlogs. There is even a risk that the value of the inventory will reduce to 0 when the product becomes obsolete. So you should beware of manufacturing companies whose inventories increase and decrease rapidly at certain times on their earnings. 3. Financial fraud associated with fixed assets. The market price of fixed assets, like equipment, may continue to fall because of obsolescence and idleness, which makes their realizable value is lower than book value. Thus, these equipments need to be depreciated. However, some listed companies deliberately do not make provision for falling prices of the company's fixed assets in order to increase current profits. In this regard, the fraudulent method of fixed assets is somewhat similar to that of inventories. When it comes to fixed assets, we should bear in mind two key points. 1. Fixed assets will suffer wear and tear and eventually be scrapped. Therefore, it is necessary to depreciate it over its economic life. 2. Apart from depreciation, it is necessary to carry out impairment tests. Therefore, fraud behind fixed assets is also common in the balance sheets. 4. Financial fraud associated with goodwill. What is goodwill? Jack's company recently acquired Rose's company for $30 million. However, Rose's company had a market cap of only $10 million. Then we're confused where $20 million has gone. In the financial report of Jack's company, $20 million is booked under goodwill. You may ask again, why Jack's company spent an extra $20 million to acquire a company with market capitalization of only $10 million? Now we will talk about the concept of goodwill. Goodwill refers to the capitalized value of a company's ability to generate profit above the recognizable book value of the company's assets. Sounds complicated, doesn't it? In fact, goodwill is an intangible asset. It can be regarded as a brand defect in the eyes of consumers. For example, if you want to buy a chocolate bar and not familiar with chocolate, which product would you choose? Dove's or another unknown brand? I believe there is a good chance you would choose Dove, as its advertising creates goodwill, which is associated with brand and quality in the eyes of consumers. This goodwill will help the company secure a higher premium. Thus, a company with higher goodwill can justify a higher price than their competitors. Goodwill is an intangible asset that brings solid profit to a company. Many companies acquire other enterprises in the process of development. Blind expansion often results in a high percentage of goodwill in the company's revenue. However, only a few companies can benefit from merger. So the higher proportion of goodwill means the higher probability of the company's failure. How is financial fraud committed in association with goodwill? As a matter of fact, goodwill sometimes suffers impairment as well. If the deals fail, then goodwill is impaired. If no provision is made in order to make the financial report look good for the current period, there is the risk that profit will fall sharply in the future when a large amount of impairment needs to be made. Goodwill impairment will happen sooner or later. Listed companies have the discretion whether to do it slowly or all at once. Thus, goodwill impairment is a key lever of listed companies to manipulate profit. In 2020, many China A-share-listed companies carried out goodwill impairment around the same time. Consequently, the share prices of these companies plummeted despite their good finances, leading to losses of many investors. Goodwill is certainly a number we should pay close attention to. Investors should be aware of companies that have a large amount of goodwill. You should look carefully at their financial report. If you find you can't figure out the composition of goodwill or the acquired company has bad performance, you should stay away from this company. The above are the 4 most common types of financial fraud in the balance sheet. Of course, in the capital market, the number of new and more sophisticated types of fraud is even increasing. However, if you can keep these 4 types of fraud in mind, you should be able to avoid many investment risks. Now, let's summarize. In this session, we focus on the 4 common types of financial fraud. No matter what kind of fraud occurs, as long as we read it more carefully, it's easy to find these tricky numbers. Reading the financial report with a method, and you will surely do well. In next lesson, we will help you to understand the current assets and non-current assets of the balance sheet, which is the key to determining the return on assets of a company. Having learned this method, and you will be one step closer to knowing whether a company is worth investing in. See you next time!